Katy, maybe we'll start with you. Maybe you can introduce Ara Partners and what you guys have been up to.
Yeah, absolutely. So Ara Partners is a private equity firm focused on industrial decarbonization. We typically bucket our investments into 4 groups: energy efficiency and green fuels, chemicals and materials, industrials and manufacturing, and food and ag tech. We have 23 portfolio companies across 3 funds today. We're in the process of raising our 3rd fund and have $2.5 billion in AUM today, and our 3rd fund will be $2 to $2.5 billion. We invest in North America and Europe. I'd say 60% of our deals are in North America, 40% in Europe, and we'll do 2 types of deals: buyout, so traditional PE transaction type, but also what we call process technology rollouts. Quite a mouthful, but basically what that means is we'll take a proven technology that has some level of commercial buy-in and back a management team to develop those assets across North America or Europe. Have some examples of that with our circular plastics investments. And we're based in Houston, Boston, and Dublin.
And so this is almost like focused on the project developer community, right? So
Yeah.
These are interesting niches in the market that can be served by an existing, well-proven technology, but there's some proprietary insight that is being brought in by a management team.
Yeah, that's exactly right. We have probably 30 projects today that are in the planning, evaluation, or construction phase today. So we have a group we call Ara Portfolio Services that comes from BP, an EPC group called Kent, and brings all of those best practices and very large company resources to all of our portfolio companies, many of which are much earlier in terms of their history.
John, maybe an introduction to Sterling.
Sure. So the Sterling Group, for those who don't know, it's a private equity firm also based here in Houston. It's been around for about 40 years. Our origin started with the creation of Kane Chemical prior to its sale to Oxy back in the 80s. Gordon Kane was one of our founders. During that 40-year period, we've done the same type of investments, which is an investment in manufacturing, distribution, or industrial services. With that chemical background, you can imagine that we found our way into some pretty interesting recycling-powered business models, which we'll talk a little bit more about later. In terms of size, we're investing out of our 5th fund, which is a $2 billion fund. We have a total of about $4.5 billion of assets under management.
So a little bit of a digression, but both of your firms are now raising funds. I guess, what is the general climate for raising funds these days?
Say overall, a relatively challenging environment, but we've seen very strong interest from existing LPs and new LPs in the area of decarbonization and increased interest in putting dollars to work in these types of deals. So our fundraise has been going quite well, luckily.
Yeah, I think it's a similar story for us. Our latest fundraising activities have just been on our lower middle market fund, which is called the Foundation Fund. That's to invest in small businesses that are smaller than what the main fund would do. We closed that fundraise at our hard cap, but it was all with existing limited partners, meaning folks are doubling down with investors with whom they've got a long track record of success with.
So, Katy, maybe can you talk a little bit about some of the Ara's investments more broadly in chemicals, and then I know you are like the resident expert on recycling within Ara, and then zoom in on there.
Yeah, sure. So, a number of investments related to chemicals. We have 4 companies tied to circular plastics, 2 related to PET, 1 mechanical PET recycler in Europe, a PET converter that uses primarily rPET, and then 2 LDPE recyclers, both mechanical. 1 is in Europe, 1 is in the US. We also have a specialty chemicals type of company. It's called BioVeritas, that takes food waste and puts it through a fermentation and distillation process to produce all natural ingredients. Its main product will be a mold inhibitor, displacing like a petchem derived product.
And are there like some common themes or investment theses that led you to build this portfolio?
Yeah, I mean, waste to value is sort of a key theme across many of Ara's investments, probably the vast majority. I think typically what we're looking at in the circular plastics investments are very large markets driven by end customer and regulatory requirements around inclusion of recycled content, coupled with, since the advent of change in Chinese legislation prohibiting the importation of waste plastic, abundant feedstock to some extent. We'll, I think, touch on those dynamics in a bit, but creating an initial supply of feedstock in the US and in Europe that needs to get processed into post-consumer resin.
Excellent, thank you. John, can you maybe talk about similarly your portfolio?
Yeah. Different approach, but led us to a very similar destination. So as I mentioned, we invest in manufacturers, distributors, and industrial services businesses. Within manufacturing, do a lot of work in building products, also in packaging. So what we did is jumped all the way back upstream to the MRF and then followed all of the various plastic streams downstream into when they found their way into either building products or packaging, and identified opportunities where there were businesses that were using recycling assets as a means of generating a competitive advantage in terms of either cost of the input stream, but more so quality as well. And so that led us to two different investments, which have now, one of them split up into two. One's a business called Tangent Technologies, which fabricates synthetic lumber. It's basically a homogeneous substrate. It's all HDPE. And they had internally a recycling center and set of core capabilities. The other is a business that used to be called Polychem, which is subsequently split under ownership into two different businesses. One is Greenbridge, which just manufactures end-of-line strapping products, mostly consumables, but they also do the equipment. Most of that is PET, so we're very well versed in that market. And then the other is Evergreen Recycling, which started off as, just as in the case of Tangent, a captive mechanical recycler aimed at delivering feedstock into the manufacturing sort of sister business. That was pulled out and combined with several other assets, one of which was purchased out of a Carbon Light bankruptcy process, and another acquisition, Ultra Pet, to combine a pure play PET-focused recycler. So, to say it differently, we sort of follow the waste streams into when they're being upcycled, or pick your favorite term, and doing so as a way of delivering feedstock into a sort of a regular industrial manufacturer.
And in those investments, there's not a big technology risk, it's more execution and scaling risk, or would you say that there is some technology risk as well in those two investments?
Well, I guess, less so pure technology, but I think as a lot of people in the room can attest to, standing up a brand new facility that's going to do 110 million pounds of mechanical recycling, maybe you're not solving a technology issue, but there is a lot to be figured out, even if you've got a sister plant across the country that can do it just fine. Getting SSPs up and running at spec, there's a lot of know-how and innovation that comes into just standing those kinds of facilities up. So I'd say those are the challenges that we've more encountered, less so pure technology.
Yeah, and I'm not minimizing the challenges of building a new plant by any.
We're just knuckle dragging mechanical recyclers,
But no, that's. I guess what I'm trying to ask is, obviously, as recycling grows and we start building out, there's a pretty significant level of investment that needs to happen, and that is probably the primary value proposition of some of those investments. Would that be fair to say, or are some of these also developing and commercializing new interesting technologies or ways to do this?
I'll take a second and keep on top. For Sterling's portfolio companies, two of those three I mentioned use mechanical recycling capabilities as a means of developing a competitive advantage against their competitors, who in many cases don't have any such capabilities. So what it allows those businesses to do is to jump into and out of various input stream markets in a way that others cannot. And so the way that manifests for them is ultimately a delivered cost to their customers and a guarantee of supply and quality that, say, other competitors don't have. So it's certainly important. What I'd say, and we'll talk about this I'm sure later, is the amount of demand that was suddenly sort of drawing a vacuum on finite supply has made players like tangent, which is consuming HDPE. We can consume post-industrial, post-consumer, virgin. We're just optimizing delivered cost. And same as in the case in Greenbridge, we can consume any host of inputs or optimizing around cost ultimately. So when you have CPG players seemingly doing uneconomic things, it actually is to the detriment of those who have been in the business, at least in our case, for a very, very long time, because suddenly recycled resin prices is sort of disconnected from the underlying economics, really just because of this fundamental supply-demand mismatch on PET and HDPE, and the list goes on. So for those two businesses, actually, incremental supply and more activity in and around addressing that challenge will be good for both in the form that it allows us to leverage those capabilities more. For Evergreen, which is just a pure play recycler of predominantly PET, I think generally speaking, of course, all of the investment in energy in and around creating incremental supply is good for that business, but so too is high rPET prices, because that's the market they're selling into. So it's a bit of you want more supply, but not so much that the pricing totally collapses. So that's the balance. What about you, Katy?
Yeah, so I would say, two of our portfolio companies that I work with directly, with LDPE, flexibles are more challenging to recycle. There's been less investment in that space in terms of both recycling capabilities, but also the equipment manufacturers' investment in their technology offerings. And so I think there is more that a company can differentiate on there, basically through their own trial and error, through their modifications to processes. But it's a similar set of steps, a similar set of technologies that recyclers across Europe and the US are utilizing. One of our investments, Repeats, in Europe has acquired 4 different LDPE recyclers across Europe, and they're all using similar steps in the process, but depending on how they're doing it can drastically lower their electricity cost, which other than the feedstock is their biggest cost doing business. So definitely can create some sources of competitive advantage, but the technology is just in a more incipient stage.
But companies like BioVeritas, on the other hand, pretty significant technology. It's a new technology with a lot of technology.
Exactly, yeah. So that technology was developed over several decades, originally intended to produce jet fuel under prior ownership several owners ago, and ultimately repositioned to focus primarily on the food and nutrition, both for animal and human nutrition markets. And there is a significant process and technology differentiation there.